On January 29th, 2026, something happened that most people will never fully understand. In less than 1 hour, over $6 trillion was erased from the gold and silver markets. Not over days, not over weeks. 60 minutes. Charts collapsed. Stops were vaporized. Margin calls detonated. And retail investors everywhere asked the same question: what just happened? This was not random. This was not panic, and it was definitely not an accident. This was a liquidation cascade. And if you don't understand how it works, you are the product. The illusion. Every retail investor falls for most people watch metal charts. Gold up, silver ripping, momentum strong, confidence builds. What they don't watch is the US dollar index, the DXY. That blind spot is where fortunes are made and destroyed, because gold and silver don't move on belief, they move on liquidity, and liquidity flows with the dollar. The first domino. The dollar spikes. On January 29th, the DXY surged. Hard, fast, violent. When the dollar rises sharply, metals must fall, not because gold suddenly loses value, but because capital rushes into dollar-denominated assets. That's the math. That's the mechanism. And institutions know it before you see it on a chart. How institutions play this game. Big money doesn't chase candles. They engineer conditions. Here's what happened behind the scenes. Institutions sold metals near the highs. They watched retail pile in. They waited for a dollar catalyst. Then they pulled the rug. When DXY spiked, algorithms fired, stops were hit, margin thresholds breached. Selling begot more selling. Not because fundamentals changed, but because forced liquidation has no emotion. Why silver got hit harder than gold? Silver didn't just fall, it collapsed. Why? Because silver isn't just a monetary metal. Over 50% of silver demand is industrial. So when news hit of a Chinese economic slowdown, silver was double exposed. Weak industry equals less near-term demand, faster liquidation, higher volatility. Gold fell. Silver got executed. The third trigger. No one connected. Then came the political noise. Fears of a US government shutdown resurfaced. Markets hate uncertainty. Funds locked in profits. Risk desks tightened exposure. Retail panicked. And panic is the accelerant. This wasn't a crash. It was a transfer here. As the part no one on mainstream media will say, this was a wealth transfer. From overconfident, overleveraged, underinformed, to patient, liquid, prepared institutions sold into strength, then bought into fear. Retail did the opposite. As always. Why this feels familiar. If this feels like deja vu, it should. The same thing happened in late December 2025. Sharp crash. Panic headlines. Everyone called the top. Then January delivered one of the strongest rallies in years. Markets don't repeat exactly, but they rhyme relentlessly. The biggest mistake you can make right now selling because you're scared after a liquidation event is how losses become permanent. Volatility does not mean thesis failure. It means positioning failure. And that distinction decides outcomes. Who this event was designed to target. Let's be honest. This move wasn't aimed at long-term holders. It was aimed at leverage traders, momentum chasers, late entrants, chart-only thinkers. The people who believed price only goes one direction. Markets exist to punish certainty. If you hold physical metal, this part matters. If you hold physical gold or silver, this event changes nothing. You're not leveraged. You're not forced. You're not liquidated. Physical metals are not trades. They are insurance. If you trade with leverage, this is your warning. Leverage turns volatility into annihilation, especially in macro-driven markets. If you don't control risk, the market will control you. What smart money is watching now, not price, not hype. They're rewatching. The dollar index, policy language, liquidity conditions, fear levels. Because rebounds don't start with optimism. They start with exhaustion. Why this may not be over, yet liquidation events come in waves. First wave clears weak hands. Second wave tests conviction. Third wave resets the trend. We may already be between wave 1 and 2, which is exactly where opportunity hides. Setting up part 2. Here's the critical question. Was this crash the end or the setup? History suggests one answer, but confirmation comes from signals, not hope. In part 2, we going to break down the 4 signals that decide what happens next, why February 1st matters, why silver could reclaim $120 faster than anyone expects, and how to avoid becoming exit liquidity ever again. Because markets don't reward emotion, they reward preparation. Now let's talk about what actually matters. Not fear, not headlines, not Twitter panic, signals. Because crashes don't end markets, they reset them. Signal number 1, the dollar index. Everything begins and ends with the dollar. Always has. When the DXY spikes violently, metals crash. But when that spike stalls, metals rebound just as violently. Here's what most people miss. Dollar spikes caused by fear are temporary. Dollar strength caused by structural growth is durable. This move, it was fear-driven. Shutdown risk, policy noise, positioning imbalance. If the DXY fails to hold its breakout, gold and silver don't just recover, they snap back. Signal number 2, post-shutdown reality. Markets trade rumors first, facts later. Once shutdown fear is resolved, saw it one way or another, uncertainty collapses. And when uncertainty collapses, so does volatility. That's when capital rotates back into hard assets, especially when nothing fundamental has changed. Signal number 3, China and industrial demand. Silver isn't optional, it's embedded. Solar panels don't wait. EV factories don't pause. Data centers don't negotiate. When price collapses artificially, industrial buyers step in, quietly, aggressively. They don't care about charts. They care about supply security. Signal number 4, Fed language, not action. Everyone obsesses over rate decisions. That's too late. Markets move on language, tone, implication, hesitation. The moment the Fed acknowledges financial stress, liquidity strain, economic fragility, the dollar cools and metals ignite. Why this move looks like a classic bear trap? Bear traps are violent by design. They must. Feel final. Break confidence. Create certainty of failure that asks how sellers become exhausted, and exhaustion is how trends reverse. The December 2025 crash did the same thing. Same structure, same emotions, same narrative. And what followed? One of the strongest metal rallies in years. The prediction and why it's not crazy. Here's the call. Not hype, not hope. Structure. Silver reclaiming $120 by mid-February is not extreme. It's proportional. Look at previous liquidation recoveries. Look at volatility compression. Look at historical rebounds after DXY-driven crashes. This is not about new highs. This is about mean reversion. And mean reversion is ruthless. What you should and should not do. Let's make this practical. If you hold physical metal, do nothing. You already won the hardest part, patience. If you trade, reduce leverage. Volatility doesn't care about conviction. If you're in cash, scale in slowly. Fear creates discounts, not guarantees. If you bought the top, this is where discipline matters. Selling bottoms locks pain, understanding structure unlocks recovery. The real lesson of this crash, this wasn't about gold, this wasn't about silver, this was about education. Markets don't punish risk, they punish ignorance of risk. Retail lost money not because metals failed, but because they didn't understand the dollar, liquidity, leverage, timing. Institutions did, and they always do. This is why most people never win. They react, they chase, they panic, they repeat. And while professionals wait, observe, deploy, accumulate, the market is a machine, and it eats emotion. Final thought. Every crash feels like the end, until it isn't. Every liquidation feels personal, until you see the pattern, and every wealth transfer is invisible, until you're on the wrong side of it. This wasn't chaos, this was structure, and now you see it. Stay patient, stay liquid, stay ahead. Because the next move will not wait for consensus.